Hey, welcome back. The show's called Your Money, Your Wealth. Thanks for tuning in today. Talking end-of-year tax planning. It's not too late to save significant money on your overall taxes, but you have to do the planning. I know the holidays are coming up. Thanksgiving's right around the corner, and then everyone kind of forgets about it. But do not do it. You still have time to put money into your pocket versus Uncle Sam's. That's the best gift that you can give, right? More money to you. Let's go to the true-false question to see where we're at there.
If I donate appreciated stock to a charity, I can deduct the value of the stock on the date of the donation and avoid capital gains taxes.
No idea.
And the answer is absolutely true. In fact, we just talked about it last segment, so this will be a good reminder. When you are donating to charity, you actually get to deduct the value of the stock that you're giving, right? So
if you bought it for, let's say, $1 a share, it's worth $10 a share right now, then I donate that to charity, then I get the $10 per share deduction.
Yeah, and even better yet, you don't have to pay the tax on the $9 gain, right? So you get the full deduction without paying the tax.
Well, and the problem is that people give cash, right?
Yeah,
so let's say, here, I want to give a $10,000 deduction, so I'm just going to give the charity cash from my checking account. Well, give $10,000 of appreciated stock. So you give the stock to the charity, they pay, or they'll sell the stock, and they don't pay tax, you don't pay tax, so it's a win-win.
Yeah, it really is.
And you get the deduction.
It's a good way to go. Now, a couple quick things to be aware of. You're limited to 30% of your income. So if you make $100,000, you can't give away any more than 30% if it's stock related. But the other thing to realize then is you have to do this by December 31st, and there is most all charities will take stocks. They're happy to do it. They're very happy to do it. Now, contrary to popular belief, the tax rates are actually at almost all-time lows.
One of the things I wanted to learn how to keep our money is a big deal.
Kelly wants to retire sooner rather than later.
I travel all over the world, and it's getting really tough on my body and things to do that.
She's attending classes at Cuyamaca College to learn tax strategies to save even more money. But what she doesn't know is her federal taxes are already at historically low levels, according to the Congressional Budget Office. The CBO just published its annual analysis of Americans' income taxes. According to the analysis, the average household pays 19.3% of its income in federal taxes in the U.S. 60% of families pay just 13%. Tax rates were about 6 percentage points higher back in 1979. So why doesn't it feel like you're getting a break? Even though federal taxes have fallen, incomes have stagnated, and when you consider inflation, most middle-class families have experienced declining standards of living over the past 7 years. Still, when you consider taxes across the board in the U.S., from income to sales taxes, Americans are getting a global bargain. Americans have the fourth lowest tax burden of 34 developed nations, according to the Organization of Economic Cooperation and Development. Kelly says she'll use whatever tax strategy she can to save additional money. She's a long way off from the number she needs to retire.
I was thinking about $3 million needed to be in there.
Well, Al, I mean, like you were talking about, tax rates are historic lows. And so when people, I mean, I get it. We're paying a lot in taxes. But if you look at the history of the tax code, I mean, when you started your career back in the 30s, I think the top marginal rate was, 90-some-odd%.
Yeah, that's what you like to say. I actually started my career in the 80s, but at any rate, but yeah, even though tax rates may be lower than most developed countries, we still want to save money on taxes, and I think we have a really good case example on how to do this.
Al. Let's talk a little bit about just a simple case of what you can do to significantly reduce your tax bite. So here's baseline, all right? So let's say there's a couple that make about $180,000 a year. They have some mutual funds and stocks and bonds outside of retirement accounts, and then that kicked out about a $30,000 capital gain. Then they have, all right, some Social Security of another $30,000. So their adjusted gross income is $240 grand. So then they have deductions, exemptions of another 20. So you get their taxable income of $220,000. AMT tax they fell into because of their income. Their tax is $52,000, 52 grand. Let's just do three quick strategies. Now, let's reduce their income because they can contribute into retirement accounts. So let's say they put $20,000. So we reduce that from 180 to 160. Now, because we can do some tax loss harvesting before year end, like we talked about, sell some individual stocks or mutual funds that are down in value to offset those gains, we're able to do that to zero that thing out, zero it out completely. Then we're going to give a little bit more to charity this year because they're in a larger tax bracket than normal. So we give a little bit more to charity. So from $20,000, we're going to give $50,000 in what is called a donor advised fund, so we can front load those deductions. And then now look, we get their taxable income to $140,000. Now they're in the 25% tax bracket. But here's the biggest thing: $26,000 to $52,000. We cut their tax in half. 3 simple strategies to save about $25,000 in tax, and you can still do this. It's just taking a look at your overall situation. Al, I mean, we look at this all the time, and there's still opportunity for people to reduce their tax burden.
Yeah, there are, Joe, and it's just a matter of knowing what you need to do before year end. And in some cases, even little things like paying an extra mortgage payment or prepaying an extra property tax payment and so forth. But here, I want to switch gears a little bit because, as odd as it may seem, in some cases you may want to increase your income because you're in a low tax year. Maybe you lost your job, maybe, so you have lower income, or maybe you have a business where you lost money. Maybe you have like a net operating loss carryover from a prior year, or maybe you actually sold a rental property at a loss, and that qualifies for what's called a Section 1231 loss, which means it's an ordinary deduction. So you can take that loss against any other income. So if this is your case, if you're in a low bracket this year for a variety of reasons, then you may want to look at actually increasing your income. And a couple thoughts there is maybe you want to try to advance, like if you're going to get a bonus early next year, maybe try to receive that this year. Maybe you exercise some stock options to be able to create some more income, or maybe you sell some stock to create some income. If you have a 401k, 403b, maybe you switch to a Roth contribution rather than a regular. And a Roth conversion could be an ideal strategy for you. That's taking money out of a regular IRA and converting it to a Roth, which will grow 100% tax-free in the future. You will pay tax on the conversion amount, but if you're in a low bracket, it's a low tax to pay.
Here's the biggest mistake that we see from individuals such as business owners that might not have a great year, or maybe they have a lower income year. So let me give you another quick example. So this is case study 2. We want to increase income. And Ty, do you see how big this is? That's very large. It takes up the whole screen, just FYI. Okay, so let's say their salary, okay, is $20,000. All right, so they own a business and they have some business losses of negative $50,000. So they're just saying, all right, well, here, I'm not paying any tax. I had a bad year. My taxable income or adjusted gross income is negative, so I'm not paying any tax. Life is great. But often we see this where they're losing a huge opportunity now to add income to their tax return and not pay any tax on that, such as taking money out of your retirement accounts, your IRAs, your 401ks, your 403bs, TSPs, whatever it is, taking money out of those accounts and converting those into a Roth IRA, so those dollars will forever grow tax-free. It's a huge deal. It's really parlaying your wealth. So now let's look. 20,000, everything's same. 50,000 business loss, right? So now we do a $120,000 Roth conversion. You take $120,000 out of the retirement account, you move it into a tax-free position. Now that 120 will grow tax-free forever. So then their adjusted gross income increases, of course, to $90,000 because we added $120,000 of income. But catch this. This is the number that you want to look at. How much tax is it going to take you? $10,000 to move $120,000 into a Roth IRA? This is the biggest no-brainer. Absolutely, you have to take a look at your tax return before year end. So if you have lower income, this is a great opportunity for you to parlay a retirement income tax-free for a very, very long time. Huge, huge opportunities. You still have time to do it. So make sure that you look at your tax return, sit down with your CPA, sit down with a certified financial planner, coordinate everything to make sure that you're doing everything correctly and appropriately in the next few weeks. All right, with that being said, we got a quick break to go to, and then when we get back, we got your email questions, we got some more cheesy commercials, we got a whole gamut of good things to go. So don't go anywhere. Show's called Your Money, Your Wealth.